What's up, everybody? Thursday, August 5th. Markets bounce back, stocks bounce back today. Dow was up, S&P was up, NASDAQ was up, Russell 2000 was up. However, you can still see some lingering concern about, taper, right? Clarita talked about that yesterday. That is the Fed cutting back on its monthly asset purchases. This is now become the discussion. When is the Fed going to start to do this? Clarita said, over the next couple of months, we're going to start to talk about this. So everybody freaked out. Dollar was up. Gold was down. Bond yields were up. Now, I've talked about taper, I've talked about Fed monetary policy over and over again. This is another one of these ridiculous, hyper overreactions. And I suspect when the Fed actually does, commit to taper, even if it's going to be a small amount, you're going to see more of these reflex hyper emotional reactions. But these are market moves that you need to go against, because they are driven by a profound lack of understanding of really what these things mean and what their effects are on the markets and the economy. So yesterday I said, basically you gotta fade what's going on. Today we saw stocks higher. Stocks are going to go higher. Taper has very little fundamental impact to the economy. If anything, I would say fewer asset purchases by the Fed means more of that income that the Fed is removing stays in the economy. That is not a bad thing. That is not a negative thing. That is a positive thing, okay? The main thing we should be focused on, the main thing that I am focused on and continue to be focused on, is the fiscal situation, fiscal flows, and those are supportive. And I think I mentioned yesterday that we may be at the onset of a new credit impulse. I mean, the numbers in the banking data over the last few weeks have been very good. So that's a positive sign. I mean, we see credit demand picking up. We see loans picking up, particularly consumer loans. We saw real estate loans picking up. So we saw bank assets at record highs. By the way, the banks, and I don't know if I mentioned this, the banks are rich. If you're looking for a sector of the stock market that is undervalued because, everything has gone up so much, and in some areas valuations appear pretty stretched. If you want to look at a sector that is really, really attractive, it's the financial sector, it's the banking sector. You talk about, the gain in net worth of the banks, it's been astronomical. And that means their capital position has increased, which is, really the principal factor in determining their lending capacity. The only constraint on bank lending is capital. It's not reserves. Let me mention reserves, by the way, as long as I just did. The data just out today in the Fed weekly release shows reserves at a new record high of 4.05 trillion. It was up another 45 billion this week. Sorry about that. Up another 45 billion this week to 4.05 trillion. Look, I'm just going to come out and say it. This weekly record-breaking level of reserves every single week, a new record in reserves. The banking system is just loaded up with all this cash. There is no way that bond yields are going to continue to go up. This is like, all of this cash in the banking system is like gravity pulling interest rates down. And the only way that it will not play out like that. I mean, the only way that bond yields will not continue to slide down in this environment of, ever increasing reserves is if the Fed, actually raises the rate. Okay? So, and by the way, if it raises the rate, it would also have to not just taper, I think, it would have to reduce its balance sheet. So I just see yields continuing to go down. And I mean, every single dip in the bond market you have to buy, okay? Every single rally in treasury yields you have to sell, all right? And it's just going to keep going down. And again, I point to the fact that European bond yields are still significantly lower than U.S. bond yields. And there's no reason why that should be the case. I've speculated in the past on why I think that, that's happening. It could be because of the shenanigans we pull every couple of years with the debt ceiling. It could be with these kind of lingering threats or worries about the Fed raising interest rates. But until that happens, yields are going to come down. All right? You got to understand that. So, yeah, I mean, right now, actually, let's get back to stock market for a second. If you want to talk about sentiment, I mean, we saw a very, pretty sharp rise in bearish sentiment in the weekly AAII sentiment survey. I mean, bearish sentiment jumped up. I forget it's up to I think it was at the highest level in 14 months or something like that. I might have the number of months wrong, but it was a significant rise in bearish sentiment that, we haven't seen that in a while. So, I mean, this is not a picture, to me at least, of, unbridled bullishness. Stocks are going up. I mean, the fundamentals are clear. And the zombie reaction to, taper or the threat of taper, I mean, the selling gold, let's say, buying the dollar, that's not going to last. That's not going to last. All right? So we're still in this kind of environment where it's just kind of grinding out these gains. The pullbacks you got to buy in the stock market. I gave you one sector that looks incredibly undervalued. And yeah, I mean, that's where we are right now. And taper is not going to make any difference. And whatever taper they announce, in however months from now when they announce it, it's going to be a modest reduction in the beginning. Now, like I said, there's going to be a zombie reaction to that because there always is. But I must have made hundreds of videos on how you take zombies' money when they do things like that, when they react emotionally like that without a real understanding of what is going on. By the way, I put out my new podcast today, so the link is in the description below. Please go listen to it. I think you're going to enjoy it. And see everybody tomorrow. Bye.